Let me just connect with Mr. James Knightley, Chief International Economist at ING. James, little bit of a history, I'm a little bit of a history buff, and I say, okay, what is the importance of Jackson Hole? Okay, quantitative easing was announced in 2009. That's it. Nothing has happened in Jackson Hole after that and beyond that. So why do you think financial markets are always excited? They always look forward to what is coming from Jackson Hole, because in the last couple of years, frankly, nothing new has come from there.
Yeah, that's true, but I think it's a venue where lots of global central bankers get together and they can discuss lots of new ideas and new ways of thinking. And, potentially we may get some interest. There's always that glimmer of hope that you'll get something very interesting coming out of that. But I think, in this year's Jackson Hole Symposium, it is, of course, laying the groundwork for that first interest rate cut in this economic cycle. Now, I'd certainly agree with you that the minutes to the FOMC meeting from July have already really set us up for that September meeting. But we may get a bit more information on the glide path to where we may end up in terms of interest rates, in terms of the current thinking. Because remember, in June, the Fed was only saying one rate cut this year. So this will give them a bit more of an opportunity to lay out the case. Do they think the market's pricing of about 100 basis points of rate cuts is about right, or is it going too much, or is it going too little? So I think it's more about not firing the starting gun on rate cuts. It's more about the glide path and where we may end up.
But James, hi, morning. Firstly, I mean, the key debate for the market is, when is rate easing going to happen? Do you think a September rate cut is well in the price? And if that weren't to happen, do you think the likelihood of the markets giving an extreme reaction is also a possibility on the table?
Yeah, I think everyone is now accepting that September will see a rate cut. Even the more hawkish members of the FOMC committee have signaled that they are open to that idea. And indeed, those minutes to the July meeting suggested that some people are actually thinking they could have gone in July. So the momentum, I think, in the wake of the soft jobs numbers, the more subdued inflation prints, all are aligning in the direction of a September rate cut. It's probably going to be confirmed by Powell tomorrow or today. And in that regard, I think, it's whether it's a 25 basis point hike, 25 basis point cut, which is what the market is currently favoring, or whether they could feel the need to step up and do more. Remember, we had those big downward revisions to US jobs this week, and that's in an environment where we've got another jobs report still to come ahead of the FOMC meeting and more inflation data to come ahead of the FOMC meeting. We could still yet see a 50 basis point cut potentially.
So keeping the doors open to a 50 basis point cut as well. But James, what happens to all of those recession fears that were suddenly brought to fore? It had been raised to 25%. Now it's lowered to 20% by JP Morgan. Are you sensing any risk at all in terms of growth and possibility for recession?
I think there's always a risk, and especially this week we've seen with those downward revisions to jobs, this brought real credibility issues into the quality of the data that we've been seeing released. Now, if you're revising away a third of all the jobs added between April 2023 and March 2024, what other things have you got wrong? And I think that issue about concerns about the quality of the data coming through in a time when the economy is losing momentum, I don't think we can be categorical about anything. I think we have to say the risks are out there that we could see a more abrupt, sharper slowdown for the US economy. So I wouldn't rule out anything, basically. And certainly it just shows you the fallibility of data, not just from the US, but everywhere, from Europe, from India. None of it is, categorically always correct. There is sampling errors, there are model errors, there's all sorts of errors that can creep in. So we have to be very flexible.
So James, I just have one simple question. 2nd of August, imagine if we were having a conversation, we would have been discussing the collapse of yen carry trade, 25% probability of a recession in US according to Goldman Sachs, US labor data which was not looking all that encouraging, and the world was slipping through what was called as a risk-off movement. And the caption which a lot of financial experts used was buyers beware. Suddenly that narrative has changed. 2 weeks and it's back to square one. Indices are at new highs. gold is at a new high, Bitcoin is at a new high. What is happening, my friend? I mean, why is it getting so sudden in terms of pattern recognition?
Well, I think there's lots of things. I mean, the world is still awash with cash, and at any sort of opportunity for buying, people will get in there. I think what we need to see is clarity on the data front, and unfortunately, I don't think we're going to get that anytime soon. So central bankers around the world are touching and feeling their way through this, because as I just said, the quality of the data simply isn't there anymore anywhere in the world. And that just makes policy making all the more challenging. And so that's why I say I'm very reluctant to be too categorical on anything right now. And I think we could well be in for quite a volatile period for financial markets over the next coming 6 to 12 months or so, because I think, if we are seeing a loss of momentum in the US economy, a loss of momentum in the Chinese economy, there's going to be very, very few economies that can be resilient to all of that coming through. Because look at Europe. They export a huge amount to both the US and China. And I think there's always the risk of contagion. No one is going to be immune if there is a more global downturn. So, as I say, I think there's lots of risks out there, and I don't want to be too categorical on anything right now. So I think we just have to be flexible, wait for the data flow to come through. And I believe that we will start to see the Federal Reserve start to take a more risk-aware approach, and we will see those rate cuts coming through. And I think the risk is that the Fed ends up having to cut interest rates a little bit more than they're currently signaling.
James, so good to have you on the show. Thank you for taking the time out and sharing with us your perspective.
If you like this video, then like, share and subscribe to ET Now.